There's one stock that is about to skyrocket, in my opinion. It is an insurance technology stock. So insurance is a evergreen, massive market. Think Warren Buffett buying Geico as a cash float machine where it just spits off cash every year from unpaid premiums. And technology is always a great place to be in, even though software stocks are at risk of getting eaten by AI. So let's jump into the ticker. It's LMND, Lemonade Insurance, and talk about the company, what they do, and look at what the actual buyers and sellers are doing, aka the chart. If you like these videos, hit that like button and let's get going.
This is Sam Putnam.
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 So let's get into some info about this company. I am trying to project my voice. I feel like I'm talking like a frat boy, frat guy, but maybe this is just what actually talking is for me. So let me know in the comments how we're doing volume wise. Here's the company. They have some risks, okay? Essentially what they do is they're a marketing company. So you see their ad on like Meta or Instagram in particular, and they say, hey, you can save a bunch of money on your car insurance. And then you head over to lemonade.com and then they give you a call or email you some quotes. And they get a cut of what insurance provider you ultimately go with. So there's some risks, right? Because insurance is super regulated and they have to be careful. They're actually kind of similar to Hims in that sense, where a lot of their business is actually just connecting the customer with the drug. Like Hims has this partnership with Novo Nordisk, which actually got sort of jeopardized. Novo Nordisk was not happy with how they were reaching customers. So Hims got cut and pretty much whatever you want to call this, 40% down drop in a day. I don't think that's going to happen to Lemonade. I don't think some big insurance company, Geico, Liberty Mutual, is going to come out and say, you know, this insurance marketing technology firm is not acting in a way that we think represents our product. It's a little different. I think Hims had a lot of scrutiny because it was a biotech company, but it wasn't actually a biotech company. It was just reaching the customer for real big pharma and biotech companies. So I think the risk is smaller there. And it is at an important level here around that $52 level, going back to, this is December of last year. See it didn't quite reach it, bounced off it here, jumped up here. And then it's just having some compressed days here. It's not doing much of anything. So I do think this is a wise spot to start taking a look at it. It is a little choppy here, to be honest. It would be great if it built up some type of flag. This you couldn't have predicted because this is earnings and you don't want to be buying into earnings. But if we really go back here, I mean, there are some times where there's low risk entries and you start to get a ramp. This isn't a great example either because it could be buying into what earnings is expected to be. Here's kind of what we're talking about. Of course, I'm a little bit talking about the market in general in here because the market all went up. But rising tide lifts all boats. You do sort of have a level that Lemonade reclaims here after their earnings, goes sideways, and then when they break through that, well, you have a low risk opportunity to get in. There was a tight day here, which was tough because then you have a gap down and then it goes up. But generally, we're talking about holding for a few days. This is about 5% down. So this is right on the edge of if you would hold through this. You know, me personally, probably not. But then again, I'm not sure I would be buying in here anyway. Whereas over here, you know, we are starting to get at least some days that are only, you know, a couple percent. So if those can continue, you know, this is a big day where it wicked down and then went all the way up. I don't really like to look at what happened in the middle of the day, but in this case, we can take a look at it. Like, if you are taking a look at an intra-daily chart where you see what happens on each particular day, you might have bought up here, right? And then suddenly you're down 4 or 5%, right? If you happen to look at your phone or your computer or your laptop, whatever, wherever you see your stock portfolio, you know, you are down 5% if you bought at the worst time and sold at the worst time, or were down at the worst time. So it's a little whipsawy. It's smoother if you have a company that is just, gosh, I cannot believe I just misspelled that 3 times, is trading just with less percent change on any particular day. So, for example, Open Door is trading 10% up and down a day. Open Door is like the GME, the GameStop of this past month. Okay, so if you have an appetite for that type of risk, I'm here to help you find entries on those type of companies, but I'm not here to just tell you about those companies all the time. So, you know, here's an example of a company that is a little bit safer and kind of closer to what I've been talking about, that's sort of similar in chart to the company we're looking at right now, which is Lemonade. So here's what I'm talking about, where, yeah, there are some big up and down days, but when you start to see some really compressed days, I mean, it barely moved at all. And then if we do look at the intraday, which you can, but again, you don't have to. I tried to do it as little as possible. You can see that there are some days where, you know, during the entire day, it really basically barely moved. I mean, this is 2%, depending on where you got in. You know, maybe it was only down, you know, a percent or so at any point, which is great, because if you're taking a position on the daily chart or even the weekly chart or even the monthly chart, although I don't really recommend you do this, and you only check your phone the next month, you know, there are times where you could be down a lot, okay? But if you're being responsible with your position sizing, you're taking 10% positions on any particular week, you're really unlikely to be down more than 10% on that 10% position, which is 1% of your full portfolio. So if you have 500K portfolio, you'd be down $5,000. These are worst case scenarios. So all that to say, looking back at Lemonade, I do think it's sort of reasonable to look at a 1-day chart, unless you're, you know, Warren Buffett's grandson or something, and you've got a few $100 million that you're trying to put to work. Just daily chart is okay to look at. And if not the chart, then checking your phone every few days, every other day at least. So all that to say, this thing is shaping up, but I would like some tighter days like this one. That's all I'm trying to say. Now, that's the level, $52. As always, pretty much always, I think almost all these ideas have been, you know, you risk a couple bucks, you risk a couple percent or more, and then you try to make $10 more or 10% or more. But really, you sell half, 10% up, you hold some more, and then maybe it goes sideways for a couple weeks or longer. And then maybe eventually you get another 10%, and maybe you use one of these lines. Like this red line is good, but this dark red line, this 20-day moving average, which I have recently talked about, is on Robinhood. So if you log into Robinhood and you go to Robinhood Legend, and I'm not going to be able to log in because my phone battery just died and I need to do two-factor authentication to log in, but it looks like I'm already logged in. So these lines do come by default on your Robinhood. Like this line is the purple one here, and this line, this blue one, this is what I'm talking about. Where if we type in Lemonade, for example, which is the stock we're talking about here, if you can jump into this, this is just 2025 over here. I think we can just look at 2025. That should be all right. You can sort of see how if you get in at some point, maybe you're down a couple dollars a share, a couple percent, or whatever, 5% at max. And then let's just say 3%, saying you're down 5% on the stock and still holding sort of just makes me uneasy. I don't like that. So say you're down a few percent, you got in on one of these days, whatever. You sell half when you're 10% up. 10% of a $30 stock is $3. That's not much, right? And then you hold half and just sort of say, I'm just going to let it ride, okay? And maybe you get here and you see this blue line. This is the 20-day moving average. You see it sort of touch that line. You happen to be, you looked at your phone once every few days or whatever. You saw that your Lemonade position is down from where it was. It's not down from your entry. You can see your cost basis where you initially bought it to. You're still up on your cost basis, but you're like, this is starting to go down. Well, maybe you take a look at your Robinhood app or your Robinhood, whatever you call this, your web app, or your Thinkorswim or your whatever charting you got going on, Webull. It doesn't matter. I'm just using some different examples so everyone feels comfortable with what we got going on here, which is we got candles, green and red. Green is up. And then you got volume, which is how much people are buying. Red is, these volume bars are red when people sell. They're green when the candle was green, when it closed higher than it opened. And then you got these lines, which are just averages of the price, which are helpful. So you don't have to agonize over, is there some news about Geico that could affect Lemonade? It's like, make all those decisions when you buy it. And then, sure, if you want to buy more at some point, buy more. Some news comes out that makes the stock move in a way that you think Lemonade could be the next Geico. I'm not here to tell you how to make your investment decisions. Fine, buy more, but treat that as a separate investment from your initial investment. So you made an investment here or wherever. You went down a few percent, let's say, and you held it, or you went down 1% and you held it. It's okay to get chopped out a lot, to lose 70% of your buys and only hold 30% of them because you just immediately cut them all at 1% down. Or even less, 0.5%, if you're super risk averse. That's fine. But the 30% that you hold, going back to this example, you sold half. When you're 10% up, you're holding half. And then you sell, or you see this day, right? On your Robinhood app or on your web app. It touches this line and you're on the fence, which is totally reasonable. So maybe you sell out that day because you think it could go down more. Fine. You still made some money on that second half as well as the first half. But if you hold, maybe you wait until it touches again. It touches it up here. So now you get another chance to be like, I'm going to hold again. I know this thing's going up. It's like, well, this time you were wrong and it goes below it. Now you sell out. You're still up from the first time it touched and you make some money. So all this to say, that's sort of an example of how to do some of this investing. I don't really want to talk about the revenues of this company that much anyway. This video is already long as well. Hopefully the volume of my voice is going up. I'm working on that. And I guess I'm also talking a little bit like a baseball player or something. It's hard to get too serious about discounted cash flow and financial metrics for a company that's essentially a insurance web startup, right? I mean, it's trading a lot of momentum. It does do all these different types of insurance. I mentioned car insurance, but these are actually, none of these are car insurance, just to say how little well, they're expanding into car insurance, know about this company. Oscar's doing well as well, OSCR, and Root as well. And look, I mean, they have some news. They're expanding into car insurance. This is a massive market, by the way, car insurance marketing. I mean, you know that if you've turned on your radio or your Spotify app or whatever. So we'll see what happens. There are details. Reinsurance decrease in its quota. So anything that makes them more stable is good. If we were super into insurance tech, private equity, or venture capital, we would be all over this, okay, underwriting improvement. But right now we see a chart. We found some levels. We talked about the math of staying in a position. And if you like these sort of videos, hit that like button. If you want to talk about your ideas or just see like the best idea on a given day instead of like 8 videos that some of them come out later because I can't just put them out all at the same time because then YouTube gets confused. People get confused as well. Head over to stockscommunity.com, try it out for $25 for 7 days and see if it's for you. You can watch, at this point, there are hours of training, scanning at looking through hundreds of stocks to find the best ones, as well as sort of like I just walked through with that Robinhood example, how to stop out, sell, or how to hold half your position or a third or whatever for some extra gains. So if you haven't hit that subscribe button, hit that subscribe. And if you like the video, like it. I will see you in the next one.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.